Also now I'll get you some commentary from management. Mr. Dinanath Dubhashi of L&T Finance Holding is joining us on their numbers. Thanks so much, Mr. Dubhashi. Let's just get a sense first. NII saw a growth of 21%, but profits were impacted by a one-time DTA reversal. What were the growth drivers for this quarter's performance?
I will first of all say that I'm very satisfied with this quarter's results. The quarter was full of fairly doom and gloom for NBFCs after NBFCs were downgraded and defaulted. In this quarter, we have been able to show excellent results. With our book has grown, the focus book has grown by 19%. The defocus book, which last quarter we had said is defocused and we are running it down, we have been successfully able to run it down, and year on year it has reduced by 45%. As you rightly said, NIIs are well protected in a climate where cost of funds for NBFCs is generally going up. We have been able to maintain our cost of funds at a good level, and at the same time keep the net interest margin plus fees at a good level of close to 7%. Another driver, of course, has been that the expenses are well in control. The portfolio quality has improved substantially from last year. And you will see there is a slight deterioration from last quarter, largely due to seasonal factors. You know that farm NPAs normally go up in September and March and come down in June and December. All this has resulted in a good profit growth, and before this one-time impact, our profits have grown by about 15%.
Disbursements have been down 42% year on year. So which segments are showing signs of higher stress? What's the outlook like now on disbursements when it comes to the second half?
So overall number, you are right, minus 42%, out of which the big negative is obviously the defocused business of structured finance and DCM. We are doing zero disbursements. So obviously just by math, the disbursements will be down. But I would like to talk about a few sectors which are important. In rural, our overall book is up by 24%, but disbursements are down by about 2% overall in rural. Now, you would know that generally the sectors which are underlying to this, which is tractors, two-wheelers, are showing negative growth in the first half at least. Our tactic there, our strategy there is to maintain our strengths, maintain counter shares, and make sure that we don't suffer more than the market. We make sure that our strength, our market share is kept, and that's what we have been able to do. And while the market has lost much more, our disbursement degrowth has been just about 2%. I would like to talk about this sector specifically because we are expecting H2 to be substantially better than H1 in rural, and we are in a good position to take full advantage of that. Other than that, of course, we have seen positive growth in home loans, positive 7% growth in home loans disbursements, which shows that our strategy is going well. And we have been fairly conservative in lending to loan against properties, real estate, and infrastructure.
Right. What about your NIMs? Because they've contracted on a sequential basis. How is it that you're seeing the funding costs and consequently margin trajectory going forward?
We always like to maintain our NIMs plus fees because we don't see NIMs as our only source of income. NIMs plus fees, because fees that you get from advisory, from underwriting, for processing fees, and most importantly cross-selling, is a very, very important part of our model. And in fact, we take pride that our entire operating expenses are fully paid by the fees that we earn. And we must be, if not the only, definitely one of the couple of NBFCs in the country where just the fees pay for entire OPEX, and that's our strength. Having said that, NIMs plus fees are fairly steady, 5 or 6 basis points quarter on quarter. It's mostly math, can't be explained. Cost of funds has over the year gone up by about 30 basis points. we have moved more to long term. You would see that commercial paper, we have reduced from 18% of the balance sheet to just about 10% of the balance sheet, and hence, and we have also diversified by raising retail NCDs, ECBs, etc. We have also been able to use this priority sector on lending allowed by the government. In this quarter, we borrowed close to 1,400 crores there. As a whole, our cost of funds were limited to about 8.6%, which is about a 30 basis points increase over last year. And we have been able to pass it on almost completely to our customers and maintain our NIMs plus fees at a very healthy level. We always like to maintain NIMs plus fees in a narrow range of 6.6% to around 7%. And we have been very successful in doing the same. To answer your question specifically, we expect cost of funds to go up maximum by about 10 to 15 basis points in the second half. We don't see it affecting NIMs negatively in any way.
Right. What's your AUM growth guidance for FY 2021, and which segments will you be focusing in on with regards to growth?
As I said, our overall focused book growth has been about 19% in the first quarter, or first 2 quarters. In the second quarter. We expect this kind of trend to continue for the rest of the year. Largely, it will be rural and housing, which will be having around 20% or so AUM growth, and infra having around 10-11%. Average same 18-19% AUM growth is what we see in this second half. This is the early estimate. I normally don't give very precise growth estimates, but what I would definitely like to state is what we are seeing in the rural areas right now is excellent water tables. All the water tables and irrigation dams being full. We expect a late Kharif crop, no doubt, but a bumper Rabi crop coming before the next financial year. And hence we expect rural demand to definitely pick up in this festive season, no doubt, but especially in FY21. So we would be seeing, most definitely seeing uptick in disbursement growth as well as book growth. Overall, definitely, but especially in rural. As the rural demand picks up, the formidable strengths that we have built up in our rural business, we hope to grow faster than the market in the rural sector. So very clearly, the book growth we expect in FY21 to be better than FY20 and largely led by rural and retail housing.
Okay, Mr. Dubhashi, great having you on the show. Thank you so much for taking the time out.